You are listening to Keystone's Stock Talk Show, episode 180. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. Great to be back with you again this week. The markets are never boring, and over the week, FinTwit was all aflutter, calling issues at Swiss investment bank Credit Suisse's European Lehman Brothers moment. We'll take a quick look at this. We'll also look at a tweet from Big Short investor Michael Burry, where he references persistent sky-high valuations in the U.S. markets in many names. We also have an epic stock battle, which pitched Aaron against myself in a no-holds-barred cage match on Canadian software giant Constellation Software, symbol CSU on the TSX. Constellation acquires mission-critical specialized software companies. Aaron argues the bull case, and I crush the poor sap with a logical bear case. In our Your Stock Our Take segment, Brennan compares Canadian-listed steel giant Stelco Holdings Inc., symbol STLC on the TSX, and Algoma Steel Group, symbol ASTL on the TSX. The latter saw its share price drop last week after operational issues hit its latest quarter, and lower steel prices make for tough comparables moving into the next quarter. Aaron answers the question, or Brennan answers the question. Aaron can answer it if he wants. Brennan will answer the question from the listener on these two steel producers. So let's get into the show. I'm going to welcome my co-hosts, Aaron, the Killer Bees, Brett, and Brennan. How you guys doing? Aaron, your wife celebrated her birthday over the weekend, which is awesome. Yes, we all wish Gab a happy 29th birthday.
Appreciate
it. Did you
that.
celebrate?
Yeah, we did.
Did she celebrate?
We went out of town. We went out of town for the weekend. A couple nice restaurants and some nice family time. So,
awesome.
as a trip with your family is never really a vacation, but so I don't know if it was relaxing for her, but she said she had a good time.
So you did celebrate. That's good. Yeah. That's good.
It's good.
I had a celebration of sorts. My mother-in-law left for a month to Africa and Egypt yesterday. So happy days for me. Wow. I kid. Yvonne, if you're listening, which you are surely not listening, but we will miss you.
Where else in Africa?
I was going to say she can pick up a check once in a while, but again, she's not listening, so that's the only way I can say that. I'm kidding. Mm-hmm. Yvonne's awesome. She's going on a safari, so right to the plains of Africa, going to.
So I've heard Botswana is incredible. That's one place.
She's actually been and said it was awesome. So going back a second time, and then obviously to Egypt to see the Great Pyramids and everything.
Which
else.
It
should be awesome.
I've been to Egypt in the past, so I can.
Have you been on a safari though?
I have not. No.
Some of the conferences we're at are kind of a bit of a safari, though. Just with the barnyard oddities that we see there. Yeah, it's true. Yeah. Anyway, so do we want to look at some issues around the markets? We got a meme up there now from.
Yeah, I thought. Yeah, it was funny.
Do you want? Does anybody want to read that one?
I'll read it. I sent this
Brennan.
To the guys here. I was on Instagram and saw this get posted. So this is Jerome Powell. He's up on the screen, and he says, "I'm going to
a direct quote, right?"
This is not a direct quote, but he says, "I'm going to keep raising rates until you assholes stop trading monkey JPEGs." So for the people that don't understand this, there's been a lot of mania around these monkey NFTs called Bored Apes that have been trading. I mean, essentially it's like collectible art on the internet that people have been like trading for $20,000.
And they're doing this now, NFT. Or is this something that was happening 6 months ago?
6 months ago, still happening
I actually
now.
have a picture for that one.
Yeah. Well,
so here, we can
so
go
Brett, you've been buying your. Oh, okay, perfect. Yeah.
Oh, nice.
There we go.
No. So here we are.
Great.
3%.
I thought you had a picture of your own monkey JPEG.
Oh, of course.
NFT. Yeah.
Of course. Yeah. No, I just have a picture of Brendan on my wall.
Yeah. There you go. How much are you going to get in the
Excellent.
NFT market for that, right?
Yeah. So the volume.
100 grand at least, 100K at least.
My mom.
Okay. So yeah. So that's what I expected. A huge drop from the first quarter of this year numbers, when really the market was, in that area, especially around January, hitting a peak.
Yes.
But just crazy. I mean, not to put you on the spot, do you have any specific examples of monkey JPEGs being bought for obscene prices, or do you know what kind of prices they're?
20,000 is a low end, I can tell you, for the Bored Apes. Like they were, I think a couple even encroached $1 million.
Yeah, I think you were saying, didn't Bored Apes actually hold up better during this period than many other categories? The irony,
Bored Apes is the blue chips of NFTs.
So, okay, Brett,
as that is.
So can anybody just create one of these Bored Ape images and put it on?
Yeah.
Right. So this is the ultimate of something having value only because people just randomly decide that it should have value, right? And that is what gives it this illusion of value, or we can discuss philosophy, what is value, but that is what it is. So I could do a Bored Ape Bored Ape JPEG and put it on the NFT market, and maybe nobody looks at it, so it's worth what my JPEG should be worth, which is 0, right? Or maybe for some reason a bunch of people love it and it goes viral and it's worth a couple $100,000 or $1 million.
Yeah. So I will say, what I liken it to is any trading card, whether it's like a Pokemon card, a hockey
which
card,
have gone nuts
card,
during this period too.
They've gone nuts as well, which is kind of expected. Those unique assets do go up in price, but it does. So you can make a Bored Ape. I can right click, the meme's always right click, and I'll save as, and I own a Bored Ape. That's always the joke around it, which you can do, of course. So it's not really the art that's the value, it's the collector item, because you can trace back to the original issuance, which is the whole value proposition. I personally don't own any, just I'm putting that out there. I'm not some hoorah, NFTs are the future type guy, but I would liken them to trading cards. So if you do believe the trading cards, whatever, have value, you could argue for the same for NFTs.
Yeah, but certainly the volume, the excitement around all of these have come down, and as asset prices deflate, they probably come down.
And I'm no expert on trading cards, but I would imagine that scarcity is something that drives value for a physical trading card, right? Like if you have an original physical trading card, nobody else can replicate that because anything else is just a copy.
Yeah.
Whereas with an NFT, because it's digital, I mean, I suppose you could say that a copy is just a copy, but it is literally identical.
Yeah. So normally I know some NFTs are trying to kind of replicate that, where you'll have condition to some sort. So normally how trading cards are rated, you have like an individual company, they'll value it or look at it to see the quality of it. And you'll have like a 10 score will be a perfect condition, nothing wrong. Because if you're not in the world, you won't understand that even a tiny little misprint changes the card's condition completely. So it could take it down from, let's say, a pristine A condition card that might go for $10,000. If it goes down like to 8, an average person won't notice the difference. I personally wouldn't, but that might take it down to a few $100s because there could be thousands of that condition, but only 1 or 2 of that pristine, perfect condition. So it's hard to argue NFTs are all pristine, but then they are all unique. When most trading cards, there is some sort of duplicates. NFTs, they have the effectively what they do is they take an algorithm, they randomize a picture. That's pretty much the formula which you'll see for Bored Apes and pretty much any of the other ones. The original one, which I remember, I don't know if it was first, it probably wasn't, was CryptoKitties, which is about 5 years old now. Yes, CryptoKitties. I learned about this actually when one of my professors in university had one. So,
oh wow.
Yeah, it's not just our generation. I think he was even a bit older than Ryan and Aaron. So
wow,
whoa, he must be
even older than us.
He's on.
Yes, I know, ancient.
His deathbed, basically.
Yeah, let's be serious. He must have been. in some.
Well, I will say he was an accounting professor.
Yes.
So
yes,
there's already the derangement.
Good point. Now, okay, well, let's look at FinTwit. I think over the weekend, all aflutter over the really over issues at Swiss Investment Bank, and we talked about this Credit Suisse, calling it Europe's Lehman Brothers moment, a reference to the bankruptcy of Lehman Brothers on September 15th, 2008 or 2008, which was the climax of the subprime mortgage crisis. Generally speaking, it is the point at which one company's disaster, this is what they call a Lehman Brothers moment, becomes everyone else's problem, as happened in September 2008 when the losses at Lehman made by betting on American subprime mortgage market became insupportable. So let's look at who is Credit Suisse first. They are a global investment bank, financial services firm founded and based in Switzerland. They have some primary areas of operation. A would be their Swiss bank and wealth arm, which services essentially extremely rich people around the world. It's doing very well at present by all accounts. B would be an investment bank that is losing share. It has no prime brokerage. This is largely due to the collapse of this Archegos capital collapse. I can't pronounce that, but it was trader Bill Huang's family office or hedge fund, whatever you want to call it. It blew up in March 2021 after making massive, basically wrong way bets. Ongoing cases, there are legal liability here, fines from the pathetic oversight, really, of Credit Suisse's on the operations of this kind of quasi-fund. They also have a fund distribution suite that is, by all accounts, not the greatest business. So those are 3-4 main areas. Credit Suisse stock, what has it done year to date? It's down 56%. This is, driven by lower earnings per share expectations. In 2021, analysts forecasted $2 a share in EPS, now down to 64 cents or whatever that is in francs, 64 cents per share. That's a 68% decline. So it's not surprising to see the share price down 56%. So over the weekend, there was a sharp rise in spreads on the bank's credit default swaps or CDSs. These offer protection against a company defaulting on its debt. This is what some FinTwit and Reddit were calling Europe's Lehman moment. So is it? Probably not likely, at least not yet. I'm going to quote some figures from a tactical trader that I found on Twitter. Maybe we shouldn't be quoting them, but we will. But these are pretty easy to access. Now, he said that CDSs are a bit hard to understand, and they can be. So he is instead focusing on Credit Suisse's bonds. So the 2025 Credit Suisse bonds trade at 6.4%. If you want to compare that, for example, to Ukraine's 2025 debt, it trades at 67%. So you're talking about the Ukrainian debt default makes sense, in his opinion. Credit Suisse's debt default less so. So the bonds are pricing in pending credit event, are not pricing in, a pending credit event, because in the July quarter, Credit Suisse, if you look at their capital ratios, their CET1 capital adequacy ratios at 13.5%. Right now, that's where they were as at last quarter, within the bank's own target and well above the 8% international regulatory requirement or the 10% Swiss hurdle. So if you look at pre-2008 era, sub 5% CET1s were common. So sub 5% was common. The CET capital adequacy right now at Credit Suisse is 13.5. So it's well within the company's own target. So not likely right now a Lehman Brothers moment, but it certainly has impacted the stock and sent people into a bit of a tizzy on Twitter and Reddit over the weekend. Maybe, like I said to Brett earlier today, trying to call out make a call on their Lehman moment. Because if you can ever get that call correct, you'll be a legendary investor.
One idea is just to make the call enough times that eventually you're going to be correct.
I think we talked about that last week, right? Yeah.
And just focus on the one time you were right.
I was right. I did make 400 calls in the last month, but that one I got, look at me, right? So we wanted to look at another, we touched on that now. Doesn't look like a Lehman Brothers moment for Europe at this point, but we'll continue to monitor it, of course. Now, this morning, Brennan has a tweet I think he picked up from.
Yeah, I've got another tweet.
Michael Burry, right? The Big Short.
Yeah, and exactly. Just kind of like leading off of someone who, kind of called the Lehman moment back in the day.
That's how we
Michael
do a
J.
segue.
Burry. Yeah, that's a segue. All right.
But yeah, Michael J. Big Short.
He is. Yes, he is. So essentially, I saw this tweet last Friday, and he says, this morning, there were still 218 primary stock listings in the United States with a market cap over 1 billion and EBITDA less than negative 100 million. 29 of them had market caps over 10 billion, totaling 655 billion. Saying it again, all the silliness must go.
I'm going to make a guess that every one of these companies, or almost every one of these companies, are in the technology software space.
Mm-hmm.
Yeah.
Yep.
Yeah, I mean, there's probably some outside, but we just did a huge sweep, and I would agree the majority.
And we were just even focusing on the ones, we weren't even really looking too deeply at the ones with negative EBITDA. We were looking at the ones with high revenue growth that had at least some profitability and some positive cash flow. But even in that segment, which we would consider a much higher quality segment, certainly from a profit perspective, it's you had huge valuations in spite of the fact that like many of these companies had taken 80% cuts to the share price, and also other things to consider, like share-based compensation really distorting the profitability picture. So looking at a company looking like it had really strong margins. If you ignore the share-based compensation, but if you consider that in the earnings, then those profits turn into losses. So it's certainly not a situation in tech. Now there are some tech some specific names that we think offer good value, but it's certainly not a situation in tech that the recent downturn in that market has created opportunities right across the sector. There's still a lot of risk, and I would agree 100%.
There's still a lot of frothiness. We went over the numbers. They got so out of whack on the high side that the pendulum. We had the first half of this year with the markets down 20%, which is the worst first half in 52 years. We keep harping on that. Despite that, the pendulum has swung back just to slightly close to even in terms of valuations. And you're still looking at the face of a potential recession. You may or may not have that, but there's certainly more uncertainty now than when in 2019 to the levels 2020, just the start of 20 before COVID hit. But certainly less uncertainty than there is right now. So if you're looking at valuations that are similar to that time, it doesn't factor in any of the potential shocks that could be coming forward. So, it's something to certainly look for, and we're continuing to monitor.
Once again,
whether or not
this doesn't mean that there isn't good value in the space. Of course, there is. That value has really improved for some select names, but where we're finding those is really in a lot of the larger cap, more established companies, where it's that mid cap, super high growth. Focus on revenue, less focus on profitability segment of the tech market that was the most expensive a year ago and continues to still be relatively expensive.
Yeah, like we always say, it's a market of stocks, not a stock market. You don't have to buy the entire market. You can buy individual companies. And like some of the traditional FANGs or Magna or whatever they're called now, there are a couple companies in there right now that trade at valuations that we haven't seen. Like one of the companies trades at a valuation, its lowest valuations ever, and just has an absolute fortress balance sheet, and we continue to like it. And I think you'll be very happy if you bought it today and look 5 years into the future where you bought it at this price. Now, whether or not it has another 15% or 10% decline in it, trying to pick the bottom is very difficult and often a fool's game. Buying a great company at a reasonable price is what we would suggest. And, that's what we're focusing on in terms of the companies that we're buying right now. Now, should we get into our debate?
Let's do it.
Are we? Yeah, with that comment, right? The markets, we're done with the markets for this week. Let's look at an individual company. We've got questions on this. When we were in actually Toronto, we had several questions on the company Constellation Software. So we thought we'd do a debate. It is a reasonable business to do a debate on, which is nice to see. Constellation Software Inc., CSU on the TSX, trades at around $1,960, $41.5 billion market cap, 0.2% dividend. The company is a Canadian software conglomerate, essentially. They acquire mission-critical specialized software companies. Its goal is to create a vertically integrated portfolio of software companies, allow the acquired companies to become and maintain a leader in their respective industries. It operates in 6 groups: Valeris, Harris, Jonas, Vila, Perseus, and Topicus, which is a public company in its own right. Of all of these can be seen as little Constellation Softwares, having the ability for each management team to exercise their discretion when it comes to acquisitions with minimal corporate interference. So all these subgroups are little Constellations. It's been a massive success story, gaining over 10,000% since it listed in 2006 and a solid 178% over the past 5 months. But as they say, the bigger they are, the harder they fall, Aaron? So let's get to it.
Or, you look at the track record of a successful growth stock.
Track record, smack record, right?
Like, I should say Ryan is the bear case.
That's strange. That's really strange.
Yeah. Ryan is the bear case. I'm the bull case. Do we flip to see who goes first?
Yep.
Okay,
Brennan, let's do that. Flip it.
The honors. I'll take
Brennan.
Heads.
Okay, you take heads.
Yeah, just pull.
You got a coin, Brennan?
Yep. It is heads.
All right, so I'm going first.
Mm-hmm.
Ooh, okay.
Nice.
Let's do this.
Brennan, you gonna count him in?
I am going to count him in. Again, Aaron is doing the 4.
Excited.
You ready, Aaron?
Bull versus bear. Stock battle.
I am ready.
It's the bull. It's the bull, baby.
It's the bull. 3, 2, 1, go.
Constellation is one of the most successful stocks in Canadian market history. Proven business model and strong fundamentals across the board. Tremendous track record of financial success, growth and profitability in every year. Revenue has grown by nearly 6 times over the last 10 years, from 900 million to 5.1 billion, and net cash flow has grown by almost 10 times. Recent financial performance continues the trend, with Q2 revenue up 30% and constant currency organic growth of 2%. 5% organic growth last year. The many billions invested into acquisitions over the years have been funded primarily with free cash flow. The company rarely issues shares and maintains a healthy balance sheet. CSU stock has been resilient through the tech market crash. The share price is down only 5% over the past 12 months, while many comparable software stocks are down well over 50%. The valuation is about 35 times trailing cash flow, which isn't cheap, but you have to pay a little more for high quality assets, and we must consider this growth at a reasonable price. Time. See, if this were a rap battle, I feel like I'd want to drop the mic. But since my mic is a little big, I feel like I want to drop my mouse. I'm just worried that, I might break it. So just imagine
right on
the mouse drop.
I think you dropped something before that. So I'm not going to say what it was. It could have been acid, but no, I'm just... All right.
Wow.
Sorry.
Are you ready, Ryan? I'll count you in.
Yeah, for sure.
I'll count you in from 20. 20. Just kidding. 3.
It's really funny.
2, 1, go.
Constellation grows by acquisition, but it has a problem. Like we just saw with Michael Burry, and we talked about, tech valuations remain high. Debt is more expensive, and the company has negative organic growth. Q2 free cash flow was down significantly. Cash flow from operations was down 55%. High valuations, PE of 61, price to FFO of 24, EV to EBITDA of 22, and with $1.52 billion in net debt. Organic growth is shrinking. from 14% in Q1 2021 to 7% down to 4, down to 1, and -2 in the last quarter. Without organic growth, CSU needs acquisitions, but due to its size, management is having issues finding suitable acquisitions which meet its initial criteria, paying out a special dividend even in 2022 as it couldn't effectively deploy its capital. Constellation is not a bad company, but is it the right time to buy with high valuations, negative organic growth in the face of a recession? Growth by acquisition works until it doesn't. The only logical answer is no. Drop acid. Thank you.
Yeah. Okay, so do we make any like retorts here, or do we just leave it to the judge?
Silence? Oh, just kidding. I'm just joking.
He wants to be control for once.
I'm just joking. I mean, you can make a retort if you want. I think.
You want to know what?
The
Arguing
judges have
we
questions.
can always...
Why don't we leave it to the judges?
Yeah.
And if the judges have questions, because we've said our bit, right?
I think the judges are smart enough to know exactly.
The judges are brilliant. That's why they're in the position that they're in. They're just
man, do they look smart.
So I think the one,
especially Brennan and Brad, especially him too.
Thanks.
They look really smart.
All right.
Now that you guys are done buttering us up, so I think the one big thing that is a little concerning, like Ryan said, is we're seeing organic growth decline. I think Ryan said something like it went from 14% to 5%. Now it's negative in the last quarter. I think that's what he said.
Is there a question in that?
There is not a question in that.
Do you have a question about the organic growth in the last quarter?
No.
Okay. Because if you do, I'm happy to answer.
Aaron's
if you don't, though, I'll
wants to get something.
What was the net debt to EBITDA? Do we have
under 1?
Under 1? Okay, so that's. I don't think that's a concern.
Is that including leases?
It should be including leases. I believe it is including leases, but I'd have to.
So I don't think that the debt is.
It's not it's not a net debt.
I guess it really just
net
comes
debt to EBITDA is
down to the growth for the price we're paying. Does it offer growth at a reasonable price? So last year you said, Aaron, it was 5% organic growth for the year in 2021. Is that correct?
On a constant currency basis.
On a constant currency basis.
Let me specify that actually organic growth was positive in the quarter on a constant currency basis. It was negative when considering foreign exchange.
Okay.
For the
and overall revenue was
2%.
30%?
30%, yeah.
30%. What do you think, Brett?
Well, I can tell both of them are reading my report, well, especially Ryan. So he's been taking some of my words verbatim, to say the least.
Which is a smart thing to do.
It is a smart thing. It is a bit helpful. But on the constant currency thing, I should add that they have significant operations in Europe as well. So as their currencies have plummeted over the last year or so, it has had quite a bit of a headwind. And something which I will pose to you guys is, do you think they're going to have more opportunity for mergers and acquisitions in a recessionary scenario?
Well, I think potentially they would. But the way I would look at an acquisition strategy like that is, it's going to be a little bit volatile from period to period. There's going to be some quarters where the acquisitions are lower, some where they're higher. But you look at the track record, obviously they have the team to identify great. I mean, their track record is certainly one of the top in the market.
Mm-hmm.
I don't know if they can acquire anything anymore. It's really up in the air. After you make your judgment, I'll have another comment about that.
So I am going to say, given the 5% organic growth, which isn't bad, but like Aaron said, 35 times
2%.
35
in the quarter, 5% last year. By the way, last year's, that's constant currency as well, because I wanted to be consistent. It was 7% last year, just before constant currency, but
sometimes you benefit, sometimes
I think over the long run, seeing organic growth decline, seeing 5% organic growth while we're paying 30 times or 35 times cash flow, I am going to have to say that Ryan is the winner on this one. And I would argue that it was basically because of the coin flip. Brett, Do you?
Yeah, no, I agree. It's a bit unfair when he's taking my words. It's hard to argue against yourself.
I don't think say you agree with Brett.
I agree with myself.
Or with did you say you agree with Brennan?
Brett won the debate.
What is the judgment?
I think Ryan wins.
Yeah, I think he does.
I have just lost all respect for both of you as analysts.
You guys are awesome.
Thankfully, I didn't have much to begin with, but the little bit that I did,
it's gone.
It's gone.
Yeah.
Okay.
I gotta say,
know what? 5% organic growth is an excellent growth rate. You know, maybe they did 14 in the past. I would argue that was probably maybe in like 1 year or something.
It was a quarter.
Yeah. So Ryan basically cherry picked.
Of course he
cherry-picked the highest quarter of organic growth so that he could try and create the illusion of a downward trend. And you guys fell for it.
No.
This is literally like one of the best track records in the Canadian market. And 35 times cash flow for long.
Would you buy it right now, Aaron?
I would consider. And you want to know what? I would very much consider. And you want to know what? If it had more of a yield, I would consider it for the income stock. But I will say, and this in no way eliminates any of the statements that I've made about Brett and Brennan. Ryan, did a good job of twisting and transforming the data. Because I came in, I'm just like, Ryan's done. There's no way. He's toast, right?
Constellation's a really good company.
Though, I was kind of like, whoa, like he can definitely distort the truth.
It's true.
For his own purposes. So who knows? Like, for the extremely gullible. I'm joking, guys. I'm joking.
His political career is up next. Don't worry.
I've been telling Ryan for years he should run for office.
He already gets a hair.
That is not a compliment. That's all I can say. That is like not a compliment at all.
All right, guys, you guys stink, but whatever. I still love you both. I'm just
Constellation is
a sore loser.
Constellation's a really well-run company, and they've been able to run that very difficult line between growth by acquisition, some organic growth. It's, been coming down, but it's still not bad, in the rate. If they can do 5%, and at the size they're at is the thing. It's just a downturn should help them, to be honest. It should actually help them in terms of valuations, labor costs in technology, that could help them as well. So yeah, I mean, I would love to see them with a massive net cash position, right? Like that would be a topper for me, being involved in the company.
Oh, I'd like to see them with massive net cash, 100% growth. And
I do sometimes wonder why they
revenue.
They hadn't raised, used a little bit of share issuance when they were a little higher as well, just to use that money again in a downturn, but
they generate so much free cash flow that they've been able to.
They do it most out of cash, which is great, right?
Yeah.
It's great.
How much was the special dividend? Do you know how much?
500 million or something,
500
wasn't
million?
it?
Yeah. I'm not sure. Yeah.
It was a significant amount, I believe. Yeah. I think it was in that range. Yeah. Well, we can.
I mean, whatever. Everybody knows 500. This was a fix. Yeah. So
it's true. It's true.
I hope you guys enjoy your $5 checks.
The fix
Ryan didn't even sign. You're gonna get your checks in the mail. You're gonna be like, Ryan, you forgot to sign. He's like, oh yeah, I'll send you another check.
Wow, I like how heated this gets between you guys. I know. I like how heated this gets between you guys. I think we need more Ryan Aaron debates.
We're more heated with you guys.
No, just so everybody knows, it was Brennan and Brett's idea. They said we want to see Ryan and Aaron go head to head, and I thought Ryan was. You could see Ryan's face go white. No, I thought it was a great idea. I'm saying that he actually won. So.
Yeah, I was very perturbed.
You were so scared you couldn't even see.
I would like to look at those organic growth numbers for myself now too, just to see how much I was, dude.
Don't worry about it.
They are the raw numbers. There's no lie in what I'm saying. Picking. They're the raw numbers.
It's not a lie if you believe that it's true, right, George?
It's true.
George Costanza?
Yeah, no, it's true.
Right. No, that was a good one.
It's not you, it's me. It's not you.
It was. I think it was a good company. And in the future, I think we're just really going to endeavor to find stocks to debate where they can literally go either way. I don't know. You guys thought that won it on the coin toss. Maybe that was the way it was, but I think that was a company that could have gone
I thought
either
it was
way.
close.
Yeah, I mean, I thought that was a company that could have gone either way personally, and it's good.
I thought it was actually quite close, honestly. Even though Ryan was taking my words, when I was writing this report, I was going back and forth on it, which is why I thought it would be good.
Like a good back catcher in baseball.
So what you're saying
I framed the pitch really well. I framed the pitch
for Ryan. Isn't that kind of like if there's a court case, the judge does the closing and the opening and all the questioning for the
had my report as well. You could have.
You had access.
Yeah, I said this. You could have just torn my.
All right, let's move on.
That was good. I liked it. That was good. All right.
We got to get to Algoma and Stelco. I think it should be. This is almost a debate between the two of them, but it's we'll look at what Algoma did over the past week and what Stelco has done, and then we'll dig into those two businesses. We get a ton of questions on these companies. Yeah, we get a ton of questions on these. Too bad we assigned it to Brennan, but we'll see. We'll see what he comes up with.
Do you want me to do the segment?
Sure, he'll get the company description right.
Brennan already had a little bit of a cry before this. So.
Yeah, I did.
Oh, poor.
Okay.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So, we had a question on Algoma Steel, ASTL on the TSX, and someone posted on one of our older Stelco videos, STLC on the TSX as well. So I thought that, it might be a good idea to compare these two similar businesses. So Stelco Holdings engages in the production and sale of steel products in Canada, the United States, and internationally. It offers flat-rolled value-added steel, including coated, pre-painted, cold-rolled, and hot-rolled sheet products, as well as pig iron and metallurgical coke. The company sells its products to customers in the construction, automotive, energy, appliance, and pipe and turbine industries. Algoma Steel, very similar. It produces and sells steel products primarily in North America. It provides flat and sheet steel products, including temper rolling, cold rolled, hot rolled, pickled, and oiled products, floor plate, and cut to length products for the automotive industry, product manufacturers, for the light manufacturing and transport industries, as well as some infrastructure. So both of these companies have come under question due to their low valuations following the rise in steel prices during 2021 and 2022, and the subsequent increase in profitability for both companies. So let me just, run down the line here and kind of compare the two. So Stelco right now trades at about $34.85 and it has a $2.2 billion market cap. Algoma trades at about $9 and has a $938 million market cap. Stelco pays a 3.5% yield, which is slightly higher than Algoma's of 2.9%, and both have a payout ratio in the most recent quarter just under 4%. So they're not paying too much out in earnings, but we would expect to see this payout increase as profitability was a little lofty here, and I'll get into that shortly. So for the most recent quarter, Stelco's revenue was up 13% year over year, while Algoma's was up 18%. And Stelco's adjusted EPS was up 14% year over year, as well as adjusted EBITDA was up 13%, whereas Algoma's earnings per share were down 47% and adjusted EBITDA was up 27%. Looking forward, both companies came out with not the best guidance, obviously because of where we've seen steel prices go. Stelco's management said that adjusted EBITDA in Q3 is expected to be materially below the Q2 level, and further weakening is expected in Q4, assuming the lower prices and shorter lead times being experienced currently fully impact results and prevail through the remainder of 2022. Essentially, this is the same for Algoma, where they provided Q2 2023 adjusted EBITDA guidance in the range of 75 to 80 million, which would be a decline of 82% year over year. So you can see that they're really chewing through these tough comparables right now. Looking at the balance sheet, both are very cashed up. with Stelco having $1.2 billion in net cash, which is about 55% of their market cap. And Algoma has $1.04 billion in cash, which is 110% of their market cap. Looking for the uses for the cash, Stelco recently commenced a substantial issuer bid to purchase up to 30 million shares outstanding at $35 per share for an aggregate purchase amount of about 1.05 billion, and they're looking at retiring about 47% of their shares. And they also recently increased their quarterly dividend. And Algoma actually just recently did the same thing as well with their cash. They had a substantial issuer bid where it purchased for cancellation 41 million common shares at a purchase price of $9.75 for an aggregate purchase price of approximately 400 million. So this 400 million that they used to buy back shares was after the last quarter was reported. So we should remove that 400 million from that net cash balance that I quoted earlier. And just looking at the valuations, they are very low here, but this is looking to change, like management's guidance being very lower going forward. So right now they have a trailing PE of 1.5 times for Stelco and a trailing PE of 1.1 times for Algoma. So both businesses are heavily reliant on the price of steel, which is why each management team is guiding toward weaker quarterly results over the next few quarters. But it is great to see that both companies are aggressively retiring shares while they are cashed up from a period of increased profitability. My short and sweet conclusion is that if one was looking to purchase either stock in the near term, I think that patience may pay off, as both companies need to lap through their difficult comparable results from steel trading in the $1,800 range, as ultimately the trailing numbers will look better than the forward numbers. So once these numbers are lapped and both companies push for growth into 2023 and 2024, I think it would be good to revisit each story to really get a gauge on the growth going forward and what their valuations do actually look like. But, one last thing that I will say, it is very interesting to see how EPS or earnings per share will be affected for both of these businesses with all of the share backs. But yeah, just in the near term, I would be cautious. I think that both are good businesses, but just very reliant on the price of steel.
Right. And if we go back, about a year ago, or even say 9 months ago, when inflation was really starting to rear its head, the story was, well, commodities, that's the place you go as an inflation hedge. Like, that's what's going to do well during an inflationary environment. And really, that has not been the case at all. Obviously, I mean, we've been through it before. If you look at steel prices, iron prices, copper prices, metal prices, their lumber prices all down significantly over that period of time. Oil has performed better, natural gas better as well. But for the most part, commodities have not been a place to hide out during an inflationary period. Quite the opposite. Anybody who transitioned to a very commodity heavy portfolio in the first quarter of this year has not done well. Once again, outside of the energy space.
Mm-hmm. Yeah, I mean, it is interesting to see Algoma trading below cash value. It's net cash value per share, right? That's what it's trading at. So did it burn through cash in the last quarter? Is that expected to happen going forward, or
they still aren't burning cash yet? Like, you mean on a cash flow basis, essentially?
Mm-hmm. Yeah.
So I don't believe that they're actually burning cash yet. But I mean, we will, potentially see that in the
steel quarters. Prices, it's funny because they're still up year to date, mm-hmm. but I mean, both share prices are down year to date after, but steel, is down significantly from its highs in March, like the end of March. So, I mean, you can still have a positive year to date figure in terms of where the price of steel has went. But if it peaked, everybody got excited and then drops down 30-40%, the share prices don't do well. I mean, it's hard to be a long-term investor in some of these companies, as there's massive fluctuations from quarter to quarter. I mean, if you're looking at it like on a book value and you thought, even in down times in terms of steel, that they could, or that, they could be cash flow positive, which, you know, sometimes in the past they haven't, but if they could just burn a small amount of cash, you know, maybe that would be a place in your portfolio for a speculative position. And then you would be cashing out when there were higher prices in steel, right? Because it's just going to fluctuate a bit like a yo-yo in some of these businesses. But, you know, right now on the current valuations, like Algoma, they both look relatively cheap, but they're going to have quarters that will face periods where these had higher steel prices, lower steel prices, margins get squeezed and in many cases crushed, and you have lower EPS. So if you're looking at lower EPS, that typically, even if it's in a quarter, it doesn't drive share prices higher in the near term.
And just to give some perspective here, I pulled up the analyst estimates for Stelco. So they have here 5 analysts covering, and the earnings per share from last year about $20. So that would put them at about 1.5 times. But for the current year, earnings are expected to be cut in half to about 11.77, and then cut in half again next year to 5.23. So if you're looking at 2023 earnings, analyst estimates, now you're looking at a valuation that is, you know, in the range of 6 to 7 times, which isn't, you know, for a cyclical, commodity price sensitive stock, is not necessarily very cheap at all.
Yeah. So, I mean, it just shows you how far those earnings, if the price of steel comes down, how far they can fall off a cliff, right? So you know, it's such a significant drop. That is why, you know, you can see a company with a net cash position trading at 1.2 times earnings. I mean, it seems crazy to see that when you see it, you know, tech companies trading at 50 times sales, right? And this company's trading at 1.2 times earnings and actually goes down in a year, right? So its earnings fluctuate and can go to the negative at times, right? If you have in a quarter where you can have them lose gobs of money. Not saying these two companies, but commodity-based businesses, generally speaking. That is the risk when you're investing in these. So,
absolutely.
I think that does it for this week. I'm going to thank my co-hosts, Brett, Brennan, and Aaron. We'll continue to ask you to smash that subscribe button on our YouTube page. Sign up there, subscribe to it. Keep your questions coming into our Your Stock, Our Take segments. If you want us to compare companies, debate any businesses, get those questions in. Rate and review us on iTunes, as we still have this in podcast version, and we'd love you listening on there as well. Keep your questions coming in. And as always, we wish you profitable investing. Thank you.
Great. Thanks, everybody.
Thanks, everyone.
Thank you.